The paper has two sections. Chrp 004, that is section A, which carries 40 marks. Then we have the section B, which carries 60 marks. Section A has got 2 questions, and these questions are compulsory. Section A, it has 2 questions, and you are supposed to answer both questions. That is question 1 and question number 2. Question 1 and question number 2. Then, when you go to the other section, that is section B, it has got 4 questions. This one has got 4 questions. You attempt any 3. Attempt any 3 questions out of the 4. So you are going to leave out 1 question in that section. Section A, you need to do all of them. We have got question number 1, question number 2. Then question number 1, you might find it is number 1A, number 1B. You can find it is also going to have question 2A and question 2B. You attempt all of them. Then go to section B, you pick any 3 questions out of the 4 that are there that you feel that you are so comfortable with. Only leave 1 question there. And then each question also in section B has got 20 marks. So you will get 20 times 3, giving you the 60 marks. These are 2, each question 20 marks. 20 times 2 giving you 40. And then now if you add to this 60, giving you 100. Giving you 100%. So you need to be very careful, especially for section A, because in that section you don't have any liberty of choosing the questions. You must do all of them. And this section also, section A, because of the compulsory part, it means that you must be able to understand the whole syllabus. You might think that this area is not so friendly to me, so I'm not going to read it, only to find that area in the compulsory part. So because of that issue of some questions being compulsory, you need to have a good understanding in all the areas. Have a good understanding in all the areas so that you don't have 2 questions maybe in section A and you are not comfortable with. Any question as far as the setting is concerned? If there is no question, then we can go ahead. Allow me to emphasize something.
Walimu,
yes.
Is there a pass mark that you must get for you to have passed the paper?
The pass mark is not rigid. It is not rigid. It depends on how the paper has been performed. If it has been performed well, you find that the pass mark will go a bit up. If it is poorly performed, the pass mark will go a bit down, but we don't have a static point. But one thing I can assure you, if you score 50%, you are on the safer side. You are on this. Na 50 ni kitu kidogo sana. Hata hapo wote ongeza 10 hapa, you are done. Or you just get 10, 10, 10 everywhere. And of the 5 questions you attempt, that is, you get 10, 10, 10. You are done. You are done. It is very easy for you to pass this paper. Only that you go to that paper with the mentality of maximization. Go with the mentality of maximization. Don't do maybe the income statement and the statement of financial position, then it fails to balance. And then you spend your entire 3 hours there trying to locate the mistake. Will fail. If you do it and it does not balance, leave it. Don't cancel the work. Just leave it, proceed to the next question. And as I told you, in accounting, we don't mark the final answer. We mark entries. Mark entries. Any correct entry is a mark. Any correct entry is a mark. So we are not concentrating on the last answer. We are only focusing on how you have entered your entries from the top all the way to the bottom. You might find that it was only one transaction or entry that was misplaced. That is why it is not balancing. Out of the 20 marks, you will find that you have either 18 or 19. So it is not worth spending more than 30 minutes trying to locate a small mistake only to earn 1 mark, whereas that 30 minutes can be used in attempting another question that can earn you.
And give you more marks.
Yes. Don't spend more time in trying to locate the mistakes, especially for those questions that we know they need back to balance. The statement of financial position, maybe it is a bank reconciliation statement, it has not reconciled. Don't spend a lot of time locating mistakes in accounting. Accounting is all about entries. You can score 90% in accounting and none of your account balanced. None of them. But your transactions were recorded properly, only that you made very few mistakes here and there, but you have got very good marks. So that is it about that. Go to that.
Excuse me, Mwalimu.
Yes.
Are we around to use pencils? Because I would imagine the cancellation will be too much, especially on my side.
You are predicting that you are going to cancel too much.
You know, this is going up and down, eh?
No. The paper, unless you do your last work elsewhere and then you transfer your clean work where it is supposed to be. You are not supposed to use a pencil unless you are told to draw a diagram, which in accounting we don't draw. You are supposed to.
Oh, we are not allowed to use pencils.
It should be in a pen, blue or black pen.
Jesus
Oh,
Christ.
no.
Blue or black pen.
We have been doing all these things in pencils.
Why pencil?
So that if I need to correct something, I quickly erase and correct.
The pencil is only meant for diagrams in an exam, but for writing is a blue or black pen.
Recording in progress.
So don't worry about too much. Just know the procedure. If you do a procedure, you are done. Know the procedure, you are done. About one year, swali ya June 2019. So that is the paper, June 2019. Section A, answer both questions in this section. We have question number 1 there. Question number 1 is about the ledger accounts. The ledger accounts, where you are told enter above transaction in the relevant ledger account. The relevant ledger account. So what you need to do in that case is to open the T accounts. Open the T accounts. Hadija Enterprises Limited started its operations in June 2018 with 4 million in its bank account. The following transactions were recorded in the month of June 2018. So we need to record that amount, 4 million first. Amount of money that is meant to start the business, we call it what?
Capital.
Yes, you need to come here and open the capital account. That capital, it is the bank. So we open the bank account. open the capital and bank account, they will be affected by that initial transaction. In this case, the capital is in the bank. Remember, the rules of recording transactions in ledger accounts when it involves capital and assets, increase in capital is supposed to be credited, increase in an asset is supposed to be debited. This is a case whereby the owner has brought money to start the business. So the business is receiving money from the owner. The business is receiving money from the owner in form of capital, and that capital has been deposited into the business bank account. So capital of the business is increasing. Initially, it was zero. That's why there was no business. Now that the owner has brought in money to start the business, capital has increased from the initial 0 to 4 million. So you just write here June 03, that capital is in the bank or millions. Then the bank account has received that capital. June 3, it has received money in form of capital. Like that. So there must be an account to be debited and there must be an account to be credited so that we observe the double entry rule. We must, at any given point, an account to be debited and another one to be credited. But we have done so in accordance with the rules. Asset when it's increasing, credit. A bank, which is a current asset, when it is increasing, we debit. June 6th.
Excuse me, sir.
Yes.
Where are we getting the question paper? Sorry.
I had shared the question papers.
Oh, in the WhatsApp?
Yes.
Oh, okay.
Several.
Oh, okay. Thank you.
But even if you go to LMS,
Hmm.
there's a place where you can get all past papers for all subjects.
Oh, okay, fine.
Yeah.
All right, thank you.
June 6th. Bought stock worth 800,000 by check. When you buy stock, which is also the same as bought goods, you are supposed to.
Olimu, my skip question, June 3rd, bought furniture is worth 300,000.
This was fast then. This is not that. That is fast. I thought I had captured it. Thank you. Then that bought furniture. When you buy furniture, which is a fixed asset, you open an account for that fixed asset. A fixed asset is normally captured in its own account. So here, we are supposed to open an account for furniture. Furniture account. And furniture being an asset, whenever an asset is received in the business, we debit that asset. We debit the asset that is being received in the business. So here, we bought this furniture on what basis? We bought it by check. So the money in the bank was used to acquire the furniture. So the asset that you are acquiring, you debit. So you say this is on June 3rd. That was acquired through check. So it is affecting the bank balance. And it is how much? 300,000. Then we credit bank. Why are we crediting bank? Bank is reducing. This 4 million that we had deposited in the bank, part of it, that is 300,000, has been used to acquire the furniture. Decrease in an asset, we normally credit. So we need to come here and say, June 3rd, it has been used to acquire furniture. It has been used to acquire furniture, 300,000. 300,000. That. On 6th, bought stock. Remember, stock and furniture, they are not of the same category. Stock is goods. Goods are those items that we are buying for sale. We are buying them for sale. Anything that we buy for sale, that is bought goods or bought stock, it is supposed to be recorded in an account called purchases. Purchases account. Anytime goods are bought, we are supposed to record them in an account called purchases. The purchases is normally debited when goods are acquired. when goods are acquired, we debit purchases. So this is on June 6th. We write, how did we acquire these goods? By check. So it is going to affect the bank balance. How much? 800,000. So goods have been acquired, but we have acquired them using money in the bank. So money in the bank, 4 million that we had there, again, they are reducing to finance the purchases. Anytime money is spent, you credit that account for money. 800,000 of that. On 10th, sold goods for 700,000 to Sana traders on credit. These goods, when they are bought, we debit purchases. But when we sell them, we normally open an account called sales account. Sales account, where we record now the goods sold. When we acquire them, debit purchases. When we sell these goods, credit sales. So you come here and say, this is on June 10th. This is actually a revenue. Sales is a source of revenue, source of money into the business. Then you need to record, how did we sell these goods? If we sold them by check to the debit bank, because money could have been received in the bank. If we sold them by cash, we could have debited cash because money could have been received in the cash account. But the moment you sell them on credit, you open the name of that account of the debtor. The person who buys on credit is a debtor, and that debtor is an asset because he owes our business money. That money that he has not paid is our money. So look at that 10. Sold goods for 700,000 to Sana traders. Sana traders is a debtor. So we are supposed to have the account Sana traders 700,000. Then we go and open that account for Sana traders account. This is the debtor. This being a debtor, we debit. This is an asset. The reason why it is an asset, it is that this money that this person has is ours. And anything that is ours is an asset. So we shall come here and record it happened on June 10 as a result of what? Credit sales, 700,000. 700,000. We debit the debtor. On 15, paid that 5,000 for electricity by check. Electricity falls in the category of what we call expenses. So what you do to that, you open that expense account, electricity account. All expenses are debited when they are being paid. So for this one, it is on 16, on 15. It was paid by check, so we have here bank, that 5,000. Anytime we pay the expense, you open that expense account. Electricity, insurance, repairs, name them, rent, salaries, you open them and you debit that specific expense account. Then we shall credit bank because it is money out. So on 15, right here, money is going out to pay electricity, 35,000. So in the bank, we always credit when out, we debit when money is coming in. The same case applies to us. When the money is coming in, debit, money is moving out, credit. On the 16th, we withdrew 50,000 from the bank and put it in the cash tier. So it is transferring money from bank to cash. That is what we call contra entry. So here we shall open the cash account. Remember, cash and bank are both assets. But remember, one of them is paying out and the other one is receiving. The one that is receiving, we debit. Any asset that is received is debited. In this case, cash is receiving. That is on 18. and it is coming from the bank. How much is this? 50,000.
16th.
50,000. 50,000.
I'm saying yes, it's 50,000, but it's on 16th.
Okay, thank you. And then the same thing now, you come here and you say where the money is going. It's going to cash 50,000. It's going to cash 50,000. So when money is moving out of bank or when it is coming in, you debit. On 18th, paid 5,600 cash for wages. Wages is another expense, so open the wages account. As I've said, anytime we pay the wages or the expenses, you debit that expense. You debit that expense. So you come here and you say, June 18th, we paid by cash 5,600. That simply means that cash is moving out. Cash is moving out. We credit. This is June 18th, going to pay wages 5,600. 5,600. On 20th, Sana Traders returned goods worth 150,000. Goods that were sold but have been returned back to the business, they are known as sales returns or return inwards. So we open that account. Sales returns account. It is known as the sales returns account, and it is like the opposite of sales. When we sold them, we credited sales. When we sold them, we credited sales. But when a customer returns goods that we had sold to him or her, we now debit this. It was credited here, now we shall come and debit the sales returns. And this is on June 20th. You write to the person who has returned these goods. It is Sana Traders. How much? 150,000. 150,000. That tells us that this person by the name Sana Traders, who was supposed to pay us 700, remember he was debited because this money is ours. It is an asset from our side. Now, we were supposed to receive 700,000 from the person. But remember, the person has returned goods worth 150,000. We cannot expect this 700,000 from him. What we do, we now credit his account by, this is June 20th, by sales returns of 150,000. Don't forget what I used to tell you. When we have debited an amount, then we come, we credit an amount, it is like we are subtracting. When we have a debit and then a credit, this is in a Rieman's language, 700,000 minus 150,000, so that now we can get the amount this particular trader is supposed to pay us. So we cannot record here. If we debit, then we debit, we are increasing. We are increasing. But when you debit and then you credit, you're reducing the amount that you had initially debited. That is actually the essence. On 25th, bought goods. I say, whenever you hear the word bought goods or bought stock, you now go to the purchases. On 25th, you write, they were bought, yes, from who? From VCO, from VCO Traders. If it is on credit, you write the supplier. You write the name of the supplier. And this VCO Traders supplied us with 330,000 worth of goods. And that simply means we need to have an account for this supplier by the name VCO Traders. VCO Traders now, it is a creditor. This is now an account payable. It's a liability we owe the supplier. Any liability that we create, we normally credit. We normally credit. You come here and say, this is on June 25th. It was created as a result of credit purchases of 330,000. Credit purchases of 330,000. And then this is a liability. So whenever you have a name of a business or a name of a person, for you to be able to know whether it is an asset or a liability, you look at the side we have recorded. If it has been recorded on the credit, then it simply means that we owe the person. But for Summer Trader, this 700,000 was debited. When it is debited, that is an asset. That is the person who owes us. That is our money. So credit, you have the name of an account, the name of a person, or it is the name of a business. If it is credited, the figure is credited, we are the ones who are supposed to pay. But if it is the name of a person or the name of a business and the amount is debited, we are supposed to receive that because it is an asset. Lastly, 29, return goods worth 30,000 to Bicom. Remember, these goods were purchased. Once they have been returned back to the supplier, we call them purchases returns. Therefore, we open the purchases returns account. It is the opposite of this account. Purchases we debit, purchases returns we credit. So we are supposed to come here and say on June 29th, we return goods to Bicom. You write the name of supplier to whom goods are being returned, 30,000. Then you come to the account of that person. Remember, Bicom was demanding 330,000 from our business, but we have returned goods worth 30,000 to him or to her. This money cannot remain as 330. We need to minus the value of goods returned. If the figure was credited, minus now, you debit. Come here and say June 29, this is purchases. Purchases returns of 30,000. Then now we can get the balance. This is now what we were supposed to pay minus what we returned. The balance is 30,000 to that account. Then you need to go ahead and balance. I won't do that because I'm sure that is not something that you cannot be able to do.
Mwalimu,
Yes.
just repeat that last example of June 29th. So you said that we do not, under Vico's account, we don't put, what did we write under Vico's account?
Sorry? Under Vico's account, you debit the amount that, the value of goods that were returned, which is 30,000.
Okay, okay.
You credit purchases returns, you debit the supplier to whom you are returning the goods.
So anytime our creditor returns goods to us, we open a purchase return. And anytime our debtors return to us, we open a sales returns.
No. You are confused.
Okay.
The creditor cannot return goods to us. It is us to return goods to the creditor. Remember the creditor, we had purchased from him.
Yes, sir.
The creditor comes as a result of credit purchases from him or her. So we can only return to him or to her. The creditor cannot return goods to us. It is us to return goods to creditor. It is the customer who is the debtor. The debtors are the ones who return goods to the business because they had purchased from us. We had sold to them, so they are returning. But for the creditors, we had purchased, so it is us to return if that case arises. That's all. So anytime, just a minute, anytime we return goods to a supplier, you record that value or the value of goods returned to purchases returns. Anytime you return goods to supplier, goods that you had initially purchased, you record them to the purchases returns. Anytime a customer returns goods that you had sold, you record them in the sales returns. And then you credit the customer. For the purchases returns, you credit purchases returns, you debit the supplier, as we did here. You debit the supplier and you credit the purchases returns. But if it is sales returns, credit the customer, debit sales returns. That is the procedure. Somebody was asking a question?
Mwalimu,
Yes.
let me ask, is there a time a question can be like the capital was borrowed from the bank, such that we find ourselves debiting the capital and crediting the bank?
You have said that the capital was borrowed.
Yeah.
So capital unajua kudebit means that it is like you are shutting down the business. Yeah? Debiting capital, it is like you are shutting down the business. But when you borrow, when you borrow the money, which is part of the capital, you know now it is your case whereby you have borrowed. Either you are going to receive that money in form of a check or in form of cash. Anytime you borrow, you will receive money. Borrowing means that you are receiving something. Obviously, if it was borrowed and you receive a check, you will have to debit them.
Yes.
Then you credit the loan. The loan is a liability. You credit the loan. But remember,
so there is no time capital can appear as credit.
Capital will always be on credit.
Sorry, debit. Sorry.
I have a very clear definition of capital. Capital, what the owners have contributed towards the business. What you have brought to the business. You cannot borrow it. You must bring something first. You start the business, then along the way, you borrow now. So capital is purely the owner's contribution. So we normally debit the credit. Capital will always be credited if the business is surviving. Debiting capital simply means that now you are shutting down the business.
Okay, thank you.
Yes. So as far as first question is concerned, I hope you can remember how we used to do the balancing. This area was tackled by Mr. Ezra, and I'm sure he did a very good job. So balancing simply means that for electricity, this side has got 0, this side has got 35. The side that has less, to make sure that it now becomes equal to the side that has money. So after carry it down, actually let me start with the date. We normally do it at the end. So this one can be June 30th, the end of the month. Then you write here balance, carried it down, 35,000. So that now they can be 35,000 there and 35,000 here. That account has been balanced. The question I can ask is this. This balance, remember, carried down means at the end of the month. When we proceed to the next month, this carried down, that is maybe July 1, that carried down will be balance brought down, which we normally write below the double lines like that. The carried down, the closing balance is the opening balance for the next month. This balance carried down is on credit side, but it is on the credit side because the debit had more. So you take it back. This is on the credit, but we call it a debit balance. The reason why it's a debit balance is because it is the debit side that had more. So the balance belongs to the side that had more. The balance belongs to the side that had more. So don't focus on where you have written it. You have written it there. So that is it for question 1. We move to question number 2. Question number 2 is theoretical, talking about the characteristics or features of ordinary shares. In a company, we said we have got 2 types of share capital. We have got what we call the ordinary shares. These are actually the real owners. the real owners of the company. Then we have got the preference. The preference shares, when you buy them, you don't become the real owner. It is like actually you have lent your money to the company, and you will be earning constant dividends. And then after a specified period of time, the company can refund you the money, then you cease your shareholder. So this is like a very temporary shareholder. You don't actually have the ownership rights to the company. So you are known as the preference. And actually the word preference simply means that you are given some preferential treatment. When it comes to dividends, your dividends are constant, they are known. That's why the preference shares, you find that maybe it is 10% preference share capital. When it is 10% preference share capital, it simply means that your dividends will be equal to 10% of what you contributed, which is constant. So if you contributed like $1 million here, so your dividends will be equal to 10% of 1 million, which is going to give you 100,000. So each and every year, you are going to receive 100,000 as dividends, constant. Before the ordinary shares or the ordinary shareholders are paid their dividends, you will get yours. And in case the company is liquidating, that is shutting down, you will be paid your money back. The 1 million that you had invested there, you will be paid first before the ordinary shares or ordinary shareholders can get anything that remains. So in one way or another, the preference shareholders are given some preferential treatments. That's why they are known as the preference shares. The ordinary shares, you are the real owner, and therefore, your dividends are not constant. They vary depending on profitability of that particular financial year. If the profit is very okay, you get high dividends. If the company did not make good profit, you get low or less dividends. So they keep on fluctuating. The other character, anyway, unajua, from that explanation, I'm giving the points for that question. So number one, I've said the ordinary shares, they carry ownership right. They carry the ownership right. Number two, their dividends are not constant, and they keep on varying depending on the amount of profit that was realized. Number three, the ordinary shares, they have voting rights because you are the owner. During the annual general meetings, you have voting rights. You can vote during decision-making forums in that particular AGM. The other thing is that it is a permanent source of capital to the business. It is a permanent source of capital to the business. At no single point will the company refund you your money. It is permanent. Unless you want to cease from being a shareholder of that company, you can sell to another person so that the other person will continue enjoying the same rights you are enjoying. So, but the company cannot refund you money. Company cannot refund you money. It is a long-term source of finance in a way. So those are the features, and actually those features, they are actually the differentiating characteristic with the preference shares. So when you say that it is a permanent source of capital, this one is not a permanent source of capital. When you say that they carry voting rights, they don't carry voting rights. When we say that their dividends are fluctuating, their dividends are constant. So those are the differentiating features between the two. Question number 3 or 2. Markers traders had the following balances as at 1st November 2018. The cash and the bank. The bank, it is a credit balance. Kama bank iko na credit balance, that is an overdraft. That is an overdraft. So what are we required to prepare here? We are supposed to prepare a 3-column cash book. Before I forget, that question number 1B reminds me that you need also to go through the theory part. When we were doing the class presentations, our focus mostly was on the calculations. But if you go to the LMS, under each and every topic, there is a PDF for the notes. There's a PDF for the notes, which covers a small bit of the theoretical part. So also try to familiarize yourself with the theory part because they are also examined. Let us not forget, and we concentrate too much on the calculations. So 3-column cash book, we know how it appears. It has the column for the date, details. We said this side, because we are receiving money, from whoever we are receiving money, we can allow. So we have the discount allowed. We can allow discount. Then we have got cash bank. The same we have got date, details. Now when we are paid, we receive discount. So this side, we are going to have discount received.
And wondering.
Mwalimu, welcome. Mwalimu, we can't hear you and we can't see your board.
Okay, thank you. I was
Thank you,
saying
Karibu.
the cash book, it has got 2 sides. This is a 3-column because it has got 3 columns for recording the amount. Fine. Somebody to mute. Somebody to mute the mic. The credit side records the payment, any money moving out. Remember, you can pay using cash, you can pay using check. This side records the receipt. You can receive money in cash or you can receive money in check. That is the point. But we have got 3 columns on each side. That's why it has, or it is known as the 3-column cash book. The discount allowed is on the DR side. Why? Because when we receive money, that is when we allow discount. When we receive money, that is when we allow discount. The discount received is on the payment side because when you pay is when you receive discount. When you pay is when you receive discount. So you need to understand that. You need to understand that. Let us see what is supposed to be done here. We start with the opening balances. We start with the opening balances. For the bank, it is a credit balance. So you write here, this is the beginning of November, 1st or November 1. That is the balance brought down. So brought down is opening balance. Bank, 25,000. Record 25,000 under the bank. So the cash is going to come to this side. November 1, balance brought down. Cash, it was 61,000 debit. 61,000 debit. But then we go to the transactions during the month. Made sales, that is November 3rd, made sales of 870,000 and was paid by check. The question you ask yourself here, is it money we are receiving or is it money we are paying? When we sell, we do what? We receive or we pay?
We receive.
We receive money. That is on tab. Money is coming in from sales amounting to 870,000 by check. So this 870,000, it is a bank receipt. It is a bank receipt. That again, paid salaries. So that is a payment. Salaries, 150,000 by check. So it is a bank payment. It is reducing the bank balance. November 4, cash sales. When you sell, you receive money, so it is a receipt. This is for sales, but cash. So this 57,000 will be recorded in the cash column. November 12, John, a debtor, paid 188,000 after deducting a cash discount of 6%. John, a debtor, that is 12, paid. When a debtor is paying, remember, a debtor is a credit customer, so it is a customer paying the business. So right here, you say where the money is coming from. From John, how much did we receive? By, anyway, we are not told whether it is by check or what. Let me put there. After deducting cash discount of 6%, that part of after deducting is very crucial. After deducting simply means that we received 188,000, but the person who is John already has deducted 6%. So whenever you have that part of after deducting, you need to come and compute the discount that John deducted, because we need that figure to record it under the discount allowed. We'll come here and say, if we received 188,000 and a discount of 6% was deducted, then remember, if we were to receive the entire amount, we were supposed to receive 100%. But 6% has already been deducted by John. So John only gave us 94%, which is equivalent to 188,000, what we received. Now we ask ourselves, what about the 6% that he deducted? How much is that? We are going to have it as 6% times 188,000 over 94%. What do you get if you do that computation?
12,000.
Sorry?
12,000.
12,000. So he deducted 12,000. That is the discount we allowed John. 12,000 is the discount. 12,000 is the discount allowed. So anytime you find the one after deduction, that figure, you record it the way it is. But now you come and compute the discount that was deducted by the customer.
Excuse me, Mwalimu.
Yes.
When we are doing exams, must we show how we calculated the discount? The workings must appear on the answer sheet. Or it's not necessary. We can do it anywhere as long as it's the correct amount.
That is correct. The examiner will be marking this cash book. Eh? At the moment, you can see the 12,000.
Okay.
You calculated some.
I have a question.
Yes.
I'm sorry, but why are we doing it at 94 and not 100?
Because the person has already deducted 6%. So if he already deducted 6%, then what he gave us is 94%. That is 100 minus 6.
Okay.
Although, Stella, sorry to interject. Stella, I think you're right. You can get 100%, which will be 200,000. Then you deduct 188, you're still going to get 12,000, if that's easier for you.
Yeah, because that's how I...
You know,
what she's...
It is going to be a bit, yes, you will get the same answer, but you know, you will do this. Huh? You say if 94% is 188,000, eh? What about 100%?
Yeah.
That is what you are saying. Eh?
Yeah.
So these ones, it acquire
Yeah.
100 times 188,000 over 94%. You will get, actually, it's going to be 200,000. When it is 200,000, you deduct now what he has paid again. Eh? You deduct 200,000. That is the total amount that was supposed to be paid minus what he pays or he paid. To pata sasa to 12,000, which is what remains. It is the same thing, but I find it to be having an extra step. But all the same, it does not matter. If this one is easier for you, you can go by that. But to me, I normally say that the amount of money that I receive is equivalent to a particular percentage after deducting the discount percent. Then what about the percentage of the discount? It is the same. It depends on how you feel it is comfortable with you. On 15th, paid edge traders to 20,000 and deducted a cash discount of 5%. The question we need to ask ourselves here, when he paid to 21 or this to 20,000, has a discount been deducted or not yet?
Not yet.
Yeah.
Not yet, Cindy. So this to 20,000, it is actually 100%, Cindy. The entire amount. So how much are we supposed to deduct as a discount? 5%. So tunafanya 5% times 220,000, which is equivalent to how much?
$11,000.
11,000. This is the discount we received. If the total amount was 220,000, we have received a discount of 11,000. So how much are we supposed to pay? $189.
209.
Yeah,
209.
209.
That is what we paid. So paid agent traders to 20 and deducted a cash discount of 5%. So that is paid. So it is going to be on the payment side. We paid agent. We received a discount of 11,000. And the amount that we paid was 9,000.
209.
Yes. Salim paid 150,000 cash and
let me ask you, Mwalimu. Excuse me.
Yes.
It's not indicated whether it was paid by
cash or by check
or cash.
Actually, it was an omission.
But they're saying it's a cash discount. I can see you. Yes. But I can see you recorded it under bank.
Yes. But it is written here cash. The word cash discount there.
Cash discounts.
The discounts that we are talking about here, both the discount allowed, and discount received, these two are known as cash discounts. So the word cash discount there does not mean cash. These two discounts are known as the cash discounts. The discount that you receive for paying promptly or for paying within the stipulated or agreed period of time. So the discount that you receive to encourage you to pay within the shortest time possible is what we call the cash discount. But when they mention that word cash discount, it does not necessarily mean that they paid by cash. It was an omission. Anyway, they are supposed to tell us after deducting a cash discount or paid edge traders 220,000 by check and deducted a cash discount of 5%. That information should be complete like that. But they did not say. It is only now, from my own judgment, I find this amount to be a bit more. Only that to realize maybe it was paid by check. But even if you put it here, nobody will penalize you because the question was not specific.
Clear.
Nobody will penalize you because the question was not specific. 2018, paid Salim or Salim paid 150 cash and was allowed a discount of 6%. The question here, has the discount been deducted or not yet from the 150,000?
Not yet.
Not yet, huh? Not yet.
Yeah.
So you need to come here and do the discount is supposed to be 6% of 150,000. So how much is Salim supposed to enjoy as a discount?
9,000.
9,000. So from 150,000, if we deduct 9,000, so we are supposed to get 141,000.
141,000.
So are we receiving or paying?
We are paying.
We are receiving money from Salim. If it was paid Salim, it would have been a payment, but Salim paid, it is a receipt.
It's a receipt.
Yes, on 18th from Salim. How much? 150. Sorry, the discount we have agreed here is 9,000. Discount we allowed Salim, and then 141 is going to be received. The discount.
Mwalimu, that's cash.
Yes.
Oh,
Cash.
it's the same thing. It's the same thing.
I
You have
know.
not specified.
Mwalimu
is
paid
specified.
150 cash.
It's specified. It is specified. Yes, that one is very specific. Paid 150,000 cash and was allowed. That is very specific. The other thing that you need to remember, the discounts, we don't balance them. For this one, you just write this is going to be 21,000. For this one, you just come here and write 11,000. We don't balance them. And the reason why we don't balance them is because discount received and discount allowed are different accounts. They are not the same account. But the cash here and the cash here, it is the same account. So we need to balance it. So for this side, the cash on this side will be more. So you'll come here.
Mwalimu, we have one more question.
They have one.
We have one more. Eh? Oh, pay direct
Yeah,
expenses by cash. That is
The cash
26.
will reduce. Yes.
Yes, that is a payment of how much? 25,000 in cash.
24.
24.
Yes.
24,000 in cash. That is all. Then you balance it. Cash and the bank must be balanced. The figure here and the figure here should be the same. So you need to add for cash this side. You also do the same for this other side. This cash is how much?
259,000
Sorry?
cash. 259,000.
259,000. This side should also have 259,000. That is now the act of balancing. The difference here now, it is the closing balance. The closing balance is captured as balance carried down. For cash,
35,000.
35.
35.
We corrected or we received 259. We paid only 24. The difference of the receipt minus the payment is the balance that we have in our cash box. For the bank, this side will have more.
1,058,000.
Should be the same as this. So from this is the total we received. This is the total receipt. You minus the total payments. You get the balance. How much are you getting?
674,000.
674,000. You write it along the same row with this balance carried down. That is all. That is all about the deferred cash flow. So the only trick is only here to find out whether the discount has been deducted or not yet deducted. If it has been deducted, we use that route. This percentage is equivalent to what we received. What about the percentage that has been deducted? Is equivalent to how much? That is all. If I for section A, it was supposed to earn you 40 marks. Question section B, question 3A. Section B, question 3A.
What are these features of cost accounting?
That is which question?
2B.
Oh. No. Usually sometimes it's very funny. Huh? They call it introduction to financial accounting, but then sometimes they normally mix with the questions of cost accounting, which is or which are two different units. Huh? Features of cost accounting. Number one, cost accounting deals with cost elements in an organization. A cost element in an organization. And those cost elements, they are either labor cost, material cost, labor cost, material cost, and what we call the overheads. Overheads. Overheads are other expenses that are incurred in the course of the business. So the cost accounting deals with cost elements. The other feature of cost accounting is that the cost accounting information is meant for internal use, or it is meant to be used by the management of the organization. It is not meant for any outsider. It is not meant for any outsider. It is meant for the management, for their decision making. The other thing is that the cost accounting, it is normally prepared. It is normally prepared. Let me put it this way. It is not mandatory. The cost accounting statements are not mandatory. They are optional. Cost accounting statements are optional. There is no law. There's no law that requires businesses to prepare cost accounting statements. But the financial statements or the financial accounting statements, it is actually a mandatory, especially for companies. Especially for companies. The other feature is that what else can I say about accounting? We have said it is not mandatory. It is deals with the cost element. It is optional. It is meant for internal use. What else? What else? What else? There are quite a number. Zingine tutapata mbele. I think as I give you.
Sawa sawa.
3A. It is about the partnership accounts. We are told to do a partner's current account. Before we do the current account, we can as well do the appropriation account. This is Salim and John. Profit and loss appropriation account for the year ended 31st December 18. We normally start with the net profit. The net profit that was realized. We are given there. Bullet 3, or Roman 3. Net earnings for the year ended that 1st December 2018 was 1.4. That is the net profit. 1.4 million shillings. To this, we normally add interest on drawings. Interest on drawings. Don't know whether we have got the interest on drawings. Roman 4, The partners agreed to charge interest on drawings at the rate of 8% per annum and pay interest on capital at the rate of 10%. We have these drawings. Yes, the last statement there. Drawings during the year amounted to Salim 2.4. So interest on drawings here, therefore, it is going to be for Salim. The interest on drawings Roman 4, we are told it is 8%. So it is 8% of 2,400,000 for Salim. 2,400,000 for Salim. 8% of that gives you what?
192,000.
192,000. For Job, it is going to be the same 8% times his drawings amount, Roman 7, the last statement. Job, the drawings was 1,700,000. 8% of that gives you
136,000.
136,000. So that is what you bring here. You say Salim 192,000. Job 136,000. Can you add the two? The two combined, 192 plus 136.
$328,000.
Sorry?
328,000.
328,000.
Plus 1.4. 1,728,000. Now, from that, we less. Remember, this is now what we have. This interest on drawings, we add it to net profit because it is an income to the business. When the partners pay with interest, that interest is an income to the business. We add it to the net profit to get this figure. Then from this figure, we now do what we call appropriation. We distribute that amount. Part of that amount goes to pay. You say here as interest on capital goes to pay the partners their interest on capital. We are told that the same Roman 4, the partners agreed to charge interest on drawings 8% and to pay interest on capital 10%. This is on drawings. Interest on capital, Salim will get 10% of the capital he contributed. The capital, it is up there. The balances brought down. Capital account Salim 12 million. Then Job will get 10% of 9 million. So this one will be 1.2. This one will be 900,000. So you come here, Salim, the interest on capital is 1,200,000. For Job, 900,000. The two combined is 2.1. We are subtracting. We continue. The partners agreed to number 5. Monthly salary for each partner was 150 and 120,000 for Salim and Job respectively. Then we come here and we say less salaries. Salim get 150,000. Job to receive 120,000. The two combined 70,000. We are resting. Loan taken by each partner during the year was Salim 400,000 and Job 1 million. No interest on loan was to be charged. No interest on loan Kwa hivyo hiyo ita affect, lakini kama ingekuwa ina attract interest, kama ingekuwa ina attract interest, hiyo loan tungeiadd, interest on loan tungeiadd hapa, because it could have been like an income. It could have been an income to the business. But now, if there is no interest on loan, we cannot put the loan principal amount here, the loan's principal amount. We only put either interest on drawings or interest on loan, depending on what you are given. If the loan does not attract any interest, you leave it. Then the drawings we are told. So, can see here, it's like our figure is going to be negative. Can you do 1,728,000 minus 2.1 minus 270 to get the balance to be shared?
Mwalimu,
Yes.
the salaries that are given on the note are monthly salaries. Aren't we supposed to multiply 12? The salaries that are given.
Thank you for noting that. Huh? Thank you for noting that. Actually, we cannot record this. If it is monthly, we make them annual. So can you do 150,000 times 12?
One point.
1.8 million.
The other one, 120,000 times 12.
$1,440,000.
Plus 1.8 million. Uh-huh. 3 millions.
600,000.
3 millions. If you add these two.
240,000.
Yes.
Yeah, 240.
240. 3 millions.
Yes, 3,240,000. Can you now do this calculation? 1.728 minus 2.1 minus 3,240,000.
Six.
Sorry?
Negative 3,612,000.
600 600
12.
12.
12. Yes.
Well, yeah.
And remember, it is a negative. If it is a negative, you just put it into bracket. Then we are going to come here and now let's share of losses. Look at Roman 1. Roman 1 tells us that profit and loss sharing ratio is according to the capital contributed. Profit and loss sharing ratio is according to the capital contributed. So we have got Sarin is to job. Sarin contributed from the capital accounts. This one contributed 12M. The other one contributed 9M. So the ratio here is 12 is to 9, which can be simplified by 3, by 3, 4, which is 4 is to 3. From the capital contributed, we can get the ratio of each. 12 millions is to 9 millions, which in simplified form is 4 is to 3. So Sarin, therefore, will get a loss of 4. Remember, we normally add these, 4 plus 3 is equals to 7. So we'll get 4 over 7 times that figure. 3, 6, 12,000. Then job, the ratio for job is 3. So we put 3/7 times the same. For Salim, how much is that?
$2,064,000.
That's 64,000. For job, 3/7 times 3,612,000. How much? What is the answer?
1,548,000.
Sorry, 1,000,000?
548,000.
If you do this now, you'll realize that we are going to remain with the name. We are going to remain with the name. That is how we are supposed to do that. But remember, that is not what the question was asking. We were supposed to prepare the current accounts. The current accounts. But the current accounts, they are very easy to prepare when you have done their appropriation. Because you are going just to pick the figures from the appropriation and post them to the current account. So here we shall come and say partners current account. We have got Salim, Job. We have got Salim, Job. So this is the debit side, this is the credit side. We start with the balance for the current account that you are given, if it is any. And if the side is not indicated, the current account balance is normally on the credit, unless it is stated. Unless it is stated. The current account. So we come here and say balance, so down, starting 6,550,000. Job is 3,700,000. The opening balances for the current account always should be on the credit unless it's stated otherwise. Then what we normally credit, it is what the partners will benefit or will receive from the business. What they will receive from the business. Interest on capital is one of them. From the appropriation interest on capital, Salim was to receive 1,200,000. Job 900,000. They are benefiting. The other thing is salary. $1,800,000. 1,440,000 for each. That is what they are supposed to gain. The other one, share of profit, we don't have. What we have is share of losses. When the business makes a loss, it is you now to pay the business. It is you to pay the business. So share of losses will be here. Share of losses will be here. So on this side, we first of all record the drawings. What they need to pay the business. One, they need to refund the money they took as drawings. 2.4, 1.7. Then they need also to refund with interest on drawings. They return also with interest on drawings starting 192,000. Job 136,000. Then we have got share of losses. Starting to 064,000. Job 548,000. Lastly, there is a loan. There is a loan that they took and they need to return to the business or to fund the business by each partner during the year, 400,000 for salary, 1 million for job. So anything the partners are supposed to return back to the business should be on the debit side. Anything the partners are supposed to enjoy from the business, it is credited there. So that is the second. Where is the current account? Then you need balance. Balancing is simply making sure that for each partner, the total on both sides are equal. Where there is less, you put balance carried down. I don't know, but I know you can be able to do that. But it seems the credit side had more. So somewhere you need to insert the balance carried down. I don't want to teach you how to balance. I know you can do comfortably that. Add for starting this side, add for this side. Then if this side has more, then there must be a balance carried down here so that the totals can be the same. The same case applies to job. Question 3B. Explain the following accounting concepts. That I think was topic number 2 or 3. Accounting principles and concepts, whereby you are supposed to know that accounting as a profession is guided by the principles or the concepts which make the treatment of transactions to be similar across the globe. So the consistency concept, these are the accrual concept. It simply says that revenues and expenditures or revenues and expenses, they should be recorded in the year they occur. Recorded in the year they occur, whether they are paid or not. Should be recorded in the year they occur, whether they are paid or not. That's why when we prepare the financial statements, anything that is accrued, we add because it belongs to that financial statement. Anything that is prepaid, we less because it does not belong to that period. That is actually the accrual. We only consider what is for that financial year, whether paid or not. Anything that is not for that financial year, you deduct it. Consistency concept, it simply says that the accounting statements or the books of accounts should be prepared in the same manner. They should be prepared in the same manner, consistently from one year to the other without changing. Or the treatment of an accounting entry should be the same from one financial year to the other. You should not keep on changing. Business entity concept, a business under the owners. The business and the owners are considered two different entities. The business and the owners are considered two different entities. The transaction, the personal transactions of the owner cannot be mixed with the business transactions. Cannot be mixed with the business transactions. objectivity concept, it simply says that whenever the accountant is preparing the books of account, it should treat, or he should treat, each item with objective. We should not make assumptions here. Everything should be considered objectively without any assumption or any kind of favoritism. Recognition concept. This is how we recognize revenues. Revenues are recognized only when there is sufficient evidence that that revenue has been earned. Only when there is sufficient evidence that that revenue has been earned. Those are the 3 questions. I don't know kama tutamaliza ingine. Let us do question number 4A. Then I think we can stop there. It's all about errors. The secret of passing accounting is to make sure that you also understand the format for each and every statement. The format for each and every statement or account that you might be told to prepare. So in this case, we are told to prepare journal. Journal entries, remember, they are prepared using the general journal, whereby we normally have the date, which sometimes is the serial number when you are not given, the details, the debit, and the credit. That is the journal. So, very important for you to know how each and every statement looks like. That is the journal. So, we are told that an accountant assistant employed by Mishak Enterprises committed the following errors in the books of accounts the month of January 2019. 1, failed to record a purchase worth 25,400 bought on credit from Campesa Limited. We failed to record. That is an error of omission. When an error of omission has occurred, you have got very simple responsibility there. Just record it the way it was supposed to have been recorded. Here, it was purchases for 25,400 bought on credit from Campesa. We have just come from preparing the ledger accounts. Whenever you buy goods, whenever you make purchases, debit the purchases, and it is 25,400. Credit, either cash if it was paid by cash, or by bank if it was paid by check, or you credit the supplier if it is on credit. In this case, it was credit. We credit the supplier, who is Campesa.
What this?
Sorry? 25,400. So you simply debit the account that was to be debited, credit the account that was to be credited. And always, the general journal, you start by writing the account to be debited, and then below it, you write the account to be credited. The account to be debited should be captured first. The account to be debited should be captured first. That one has been sorted. 2, entered a sale of 46,000 on the debit side of Joshua's account instead of recordings in Joseph's account. The question that you need to ask yourself, where is the error? Where is the error? Here,
Error of commission.
Error of commission, yes. Do we have any problem with the sales account?
No.
entered a sale of 46,000 on the debit side of Joshua's account instead of recording in Joseph's account. Yes, sales account does not have any problem. The problem is the account that was debited. Remember, anytime you make sales, sales account is credited. And that is exactly what was done. It was credited. But the problem here is on the account that was debited. We debited Joshua instead of debiting Josiah. So because the correct account that was supposed to be debited is for Joshua, then Josiah, we debit the correct person, who is Josiah, by 46,000. This is the person that was supposed to be debited from the word go, but we debited Joshua. So at the back of your mind, you should remember that on the debit side of Joshua's account, there is 46,000, but it does not belong there. So how do you remove a figure that is on the debit? You credit Joshua.
You credit.
You credit Joshua. You credit Joshua to remove the 46,000 that was erroneously posted there. Number 3. The account of Jebu, a creditor, was debited with 14,700. Account of Jebu, a creditor, was debited with 14,700, while the account of Amani, a debtor, was credited with 14,700. The account of Jebu, a creditor, was debited. Remember, a creditor is a liability. It's supposed to be credited. A creditor is a liability. It's supposed to be credited. Higher. While the account of Amani, a debtor, was credited, a debtor is supposed to be debited, not to be credited. This is a reversal. This is a reversal or another
of entries.
Yes, the one that was supposed to be debited was credited. The one that was supposed to be credited was debited. So what do? We said here, the moment there is some element of reverse, the figures must be doubled. The figures must be doubled because there is an amount that is on the wrong side and we need to take it in the same account but on the correct side. Just recording the same amount, it will cancel and that figure or that transaction will stand not recorded. Anytime there is some form of reversal. Reversal occurs whereby it is the same correct account, but you have posted on the wrong side. You now do this. Take the figure to the correct side, but double the amount. Why double? The first portion of the amount is to cancel the wrong entry that was made. Then the second portion, or the second half of the amount, is to post the correct side. So you are canceling the wrong figure on the other side and posting at the same time. So here, 14,700 times 2 comes to 29,400. 29,400. That is the figure that we shall use because of the reversal of entries. It is the same account, but the figure was recorded on the wrong side. You take it to the correct side, but you double the amount so that half of the amount is to cancel the error, half of the amount is to be posted correctly. So here, the account that was supposed to be debited is for Amani. Start with it because we have said we start with the account to be debited, 29,400. Then we credit Jebu because he was a creditor by 29,400. We are done. Number 4, a cash sale of 5650 was entered in the books as 6550. That is an error of original entry when you use a wrong amount. So the question here is, we recorded by an overcast or an undercast?
An overcast.
Overcast.
Of how much?
900.
900.
Yes, 900 there means that it is excess. Remember, when we do a cash sale, we are supposed to credit sales. Sales is always credited. We are supposed to credit sales and debit cash because it was a cash sale. We did so, but we recorded in each respective side by 900 extra. So here we are tasked to remove the 900 from cash and remove 900 from sales. So when it is an overcast, when you are subtracting, you record it on the opposite side, but by the overcast amount only. So here, sales was credited because that is the norm, but it was credited by 900 more. To minus 900 from the credit side of sales, we shall debit sales by 900. Because there is excess 900 on the credit, that's why we are debiting this 900 to remove it or to subtract it from there. Then cash was debited. Yes, it was correct, but now with the wrong amount, we made an overcast on the debit of 900. So because cash has 900 extra on the debit, we credit now. We credit cash. We credit cash. That is number 4. Lastly, number 5, what happened? Recorded motor vehicle expenses of 36,700 in motor vehicle. That is an error of principle. Motor vehicle expenses. Motor vehicle expenses is supposed to be recorded in the motor vehicle expenses account, not motor vehicle account. When you record it in the motor vehicle account, it simply means that you have bought a new motor vehicle, which is not the case. That is an expense. So we are supposed to do this. Motor vehicle expenses were supposed to be debited in motor vehicle expenses. And that is what? 36,700. Remember, they were recorded in the purchases because, or they were recorded on the debit side of the purchases, though not told. Recorded in motor vehicle account, not told. Why? Because both motor vehicle and motor vehicle expenses are normally debited. So the mistake we made here is debiting the motor vehicle account instead of debiting motor vehicle expenses. So as we correct this, remember, there is this figure of 36,700 that is in the purchases account wrongly. How do we remove it from the purchases? Having been debited there, we shall credit purchases.
No, Mwalimu, it's not purchases, it's motor vehicle account.
Oh, okay. Yeah. It is motor vehicle. 36,700. So, the issue of errors, it is just about, or in most cases, it's about moving it from where it was recorded wrongly, taking it to where it was supposed to be. Here, motor vehicle expenses was supposed to be debited and was never debited, so we debit it. Motor vehicle account was debited here, but by mistake. To remove that mistake, we credit the same amount, that 6,700 that was erroneously debited. That one will cancel the error. So that is how the question was supposed to be tackled. And if you do that, everything will be okay. I hope this Sunday we can meet and we finish that paper. If we do 2, there will be nothing. Yes.
Olemo, I just have one question.
Yes.
When you look at number 4, a cash sales of
the cash sale of?
Yes, a cash sale of 5650 was entered into the book as 6550. So you said that when there's an overcast, what do? We record with that figure, that 900.
Tulisema ilikuwa overcast, sema hii ni undercast. Kwa nini tulisema ni overcast?
It was supposed to be 5,650, but it was entered as 6,550. So that was an overcast.
That is an undercast. That is an undercast.
How? More was entered.
But more
They
was
entered
entered
more.
one.
So how is
The
it an
overcast.
undercast?
Abu sasa tuulizane hapa. It was entered in the books as 55.
6,000.
Oh, 6,000. Oh.
6,550. Yes.
Unajua mimi nilikuwa naona zote ni 5,000 and sasa nilikuwa naona moja ni 5,600 na nyingine ni 5,005. Okay, it is an overcast. It is true. It is true. Now, what is the question now with regard to that?
What I don't understand is why are we using when you look at those two figures, there was that error of reversal whereby instead of
transposition
instead of writing 5,650 we write 6,550. Why can't it not be an error of transposition?
That's what it is.
Remember what we said when we were talking about those errors, huh?
or it's the same
error,
thing.
The transposition error and the error of original entry. Actually, we said transposition error is a special error of original entry. Eh? The difference between them is very thin. Eh? It's very thin because this one talks about using the different amount. This one talks about wrong sequence in the amount.
Yes, wrong sequence. No, you look at this. This is more of wrong. Okay, when I looked at it, I saw wrong sequence. So
it sounded the same. Eh? Nobody will penalize. Actually, the error of transposition, it is more or less the same as the error of original entry. It is actually one and the same thing.
Okay.
So that is it. We stop there for today. We can pick from there on Sunday. We finish these questions that are remaining. As you also revise, kindly remember to do the theory part. Then there is I don't know whether Jacqueline is with us. Jacqueline Mugure. Is she in class today? Jacqueline? I think maybe
looks like she's not in class.
She's also maybe not in our WhatsApp group because I had indicated she contacted me and she hasn't. So let us stop there.
Is she our class rep?
Sorry?
Is she our class rep? I've never known who the class rep is.
Class rep is Erastus.
Oh, okay. Erastus. It's good to know.
Erastus, huh? So
Excuse me, Mwalimu.
Sorry?
Excuse me.
Yes.
Yeah, I'm requesting for the recording for ratio analysis. It is not in the LMS.
It is not in the LMS. Okay,
yes.
I'll do so. I'll do so tomorrow. Tomorrow together with this.